You just paid $2,000 in rent this month, and you probably feel like you threw it away. Look across the street. Your neighbor, the one who just closed on a $400,000 house, the one who keeps telling you they are finally building equity, they threw away over $1,600 this month. The worst part is they have no idea. They will never see it on a bank statement. There is no line item called money you will never get back. It just leaks out, quietly, every single month. We are going to fix the math on how you decide where to live. Canadian portfolio manager Ben Felix built a framework around unrecoverable cost that collapses the renting is throwing money away narrative. An unrecoverable cost is any money you spend in exchange for having a place to live, where at the end of the year, the money is just gone. You cannot sell it back, it does not turn into equity, it does not appreciate. For a renter, this is a simple equation. Every single dollar of rent is unrecoverable. The whole bill sits neatly on one line item. The assumption that the homeowner's unrecoverable cost is zero is wrong. There are three separate buckets of money that leave the homeowner's wallet every year that they will never see again. Bucket 1 is property tax. You write the check, the local government keeps it, and zero equity is created. Bucket 2 is maintenance. A new roof, a failed water heater, fresh paint. You are paying thousands of dollars simply to keep the physical asset from rotting. Bucket 3 is the cost of capital. This is the mortgage interest you pay the bank, which is essentially just rent on their money. It also includes the opportunity cost of your down payment, the returns that cash could have earned if you had invested it elsewhere. This frames the decision as a direct comparison between the renter's single unrecoverable cost and the homeowner's three hidden ones. Ben Felix's framework quantifies those three leaking buckets. In the United States, in normal housing markets, they tend to add up to roughly 5% of the home's value every single year. The math works out to a 1-1-3 ratio: 1% for property tax, 1% for maintenance, 3% for the cost of capital. Take a $400,000 house, multiply it by 5%, and you get $20,000 a year. Divide that by 12, and the homeowner is paying $1,667 a month in invisible, unrecoverable rent. If the renter across the street is paying $1,500 a month for a comparable place, the rent versus buy math flips. The homeowner is the one losing money in actual dollars every single month. That 5% rule is a starting point, but the current housing market, specifically high interest rates, is altering this math in many regions. According to the Freddie Mac Primary Mortgage Market Survey, the average 30-year fixed rate hit 6.36% recently. That rate is high enough to change the entire calculation. Let's run the formula with that reality. The median home price in the United States sits around $396,800. Run the 5% rule, and the median American house bleeds about $1,650 a month in unrecoverable cost. Hold that against the national median rent, which is right around $2,000. On paper, buying a home on the national average still wins by about $350 a month. But the national average is a statistical lie. No individual person actually lives inside the national average. When you look city by city, the narrative fractures. A recent Empower study looked at the 50 largest metro areas. Buying is cheaper than renting in 23 of them. Renting is cheaper in 27. It is a literal coin flip dictated by geography. Look at a skyline like Chicago. The monthly mortgage on a median home is around $1,600, while renting a comparable place is nearly $2,100. Owning here mathematically dominates, saving buyers over $470 a month in unrecoverable costs. The math holds up in Pittsburgh and Miami, too. These markets heavily reward ownership, even with a 6% interest rate. Then you move to high-cost coastal cities, and the math reverses. In San Jose, the monthly mortgage on a median home is $7,500. The median rent is $3,400. The homeowner is bleeding nearly $4,100 more per month than the renter. That San Jose owner is hemorrhaging $49,000 a year in excess unrecoverable costs compared to their renting neighbor, believing they are building wealth. This pattern is consistent across the coasts. In San Francisco, the renter saves over $2,000 a month. In Los Angeles, the renter saves $1,600 a month. The buyers take massive unrecoverable losses. Local geography dictates the physical hidden costs. the property tax, insurance, and maintenance that form an invisible financial iceberg. In Hawaii, owners spend an average of $34,000 a year just keeping the house afloat on taxes and maintenance. In West Virginia, those exact same hidden costs are only $12,000 a year. Treating a coastal housing market like an inland housing market is a massive financial error. They are completely different equations. You have likely heard the generational counterargument. Your parents bought a house in the 1980s, and today it is worth 10 times what they paid. Real estate builds wealth for most people because a mortgage is a forced savings account. Sending the bank money every month under the threat of foreclosure creates an automatic discipline. A theoretical renter, on the other hand, is supposed to take the difference between their rent and what a mortgage would have cost and invest it. The behavioral reality is that most renters lack that discipline. They spend the difference on lifestyle. Homeownership wins for most people by default because the saving is automatic. But if that San Jose renter possesses the discipline to take their $4,000 in monthly savings and route it into a total stock market index fund, the math changes. In 15 years, that gap compounds into well over $1 million. To make the decision, start with the local 5% rule. Calculate the unrecoverable cost of the house you want and compare it to the rent of a comparable place. If you live in an inland city where the mortgage math works in your favor, or if you know you will spend whatever extra cash you have at the end of the month, you should buy. You need that forced savings mechanism to build wealth. If you live in an expensive coastal market and you are disciplined enough to automatically invest the monthly gap, you should rent. Prioritize compounding stock market returns over trapping your cash in an illiquid asset. For a disciplined investor running the right numbers, renting is not throwing money away. You are intentionally purchasing financial liquidity, mobility, and optionality, and no 30-year fixed mortgage gives you that.